Hello everyone, Assalamu alaikum. Can you people hear me now? Okay, good morning everyone. Well, we were discussing the Forbes company question yesterday. Now we have a B part of the Forbes company. Uh, let's try to solve this. Forbes company has in issue 9% bonds which are redeemable at their par value of $100 in 5 years time. Alternatively, each bond may be converted on that day into 20 ordinary shares of the company. The current ordinary share price of Forbes company is $4.45 and is expected to grow at a rate of 6.5% per year for the foreseeable future. Forbes company has a cost of debt of 7% per year. Calculate the following values for each $100 convertible bond. Is the screen visible now? Okay. Now, just read this question and solve it for part one. Solve it for part one. Just calculate the market value. We have learned how to calculate the market value of bonds in case the conversion option is there. So just calculate the value, market value. Sikandar, can you hear me? Okay, let's see. The first step will be to know what the decision of the investor will be by the end of the bond's life. So let's calculate the conversion value of the bond. Conversion value. Well, the bond might be converted into 20 ordinary shares, and the current share price is 4.45, and this share price is expected to grow at the rate of 6.5% per year, and the bonds will be redeemed after 5 years. So we'll have to incorporate a growth for 5 years. So what's the value of sir, 4.45 from where? Well, it's in the question. It's in the question. Just read the question. Simran, read the question. It's in the question that the current share price of Forbes company is $4.45. The conversion value is $122, right? Alternatively, it can be redeemed at par, that is $100. So the investor has two options: either to go for redemption and get $100 in cash, or go for conversion and get shares of $122. So as a rational investor, the investor is going to choose conversion. So he will be converting into ordinary shares. So this is what he's going to get. Okay, then now the second step is to calculate the market value. Now, everybody should listen carefully. Sikandar, there might be some problem with your sound system. I think everyone else can hear me. Yes, Sikandar, I'm getting your messages, but there might be some problem with your sound system. Voice not clear. I know what's wrong. Let me check. Is it clear now? Okay, thank you. So let's calculate the market value of the bond for any debt for which we need to calculate the market value. Remember one thing, we just need to calculate the present value of the cash inflows that we are expecting from that debenture or bond or any marketable debt. So remember, the market value will be the present value for the interest payments plus redemption or conversion value. So we have to calculate the present value. So let's see how much interest we are going to get from this debenture. It's a 9% bond. So we will be getting 9% every year. But remember, since it's interest, it will have a tax impact. Again, there is no tax mentioned in the question. Let me assume that the tax rate is 30% again. Remember, when we are calculating the present value, the market value of a preference share, we never incorporate tax. But whenever it's interest-bearing security, we have to incorporate the tax. So let's assume that the tax rate is 30%. It's not in the question, I have assumed it. Okay, we will be getting 9%. So what 9% of $100 will be $9. Simran, yes, at the moment it's before tax. We have to convert it into after tax. And I'm assuming that the cost of debt mentioned here is also after tax. So I'm assuming that the cost of debt is also after tax, and we have to make that 9% as even that 9% as after tax. So after tax interest will be $6.3 per annum, right? Okay. This $6.3 we will be getting every year. Rishabh, you don't need to assume tax rate in the question. If it's not in the question, you should not assume it. You should totally ignore it. Just to make things clear for you people, that's why I have assumed, so that you people always know if there is a tax, what to do with that tax rate. Sana, no, you should not assume any tax rate in the exam question. You should totally ignore it if that's not there, because usually in exam question, when there is no tax, they will mention ignore taxation. So you have to ignore tax. Well, market value has nothing to do with with before or after tax, but what we have to do is we have to take the interest that we are going to receive. Definitely, if the company, if someone is receiving 9% tax, it has to pay tax on that income as well. So the market value will always be calculated once the returns have been reduced by the tax rate. So we'll always take after tax interest. Remember this. So 6.3 is the interest that we will be expecting to receive every year. So since it will be for every year and constant, Therefore, we'll multiply it with the NVT factor. NVT factor of the cost of debt, 7%. So can anybody come up with the NVT factor of 7% for 5 years? Aisha, the $6.3 is after tax interest. Before tax interest is 9%. It's 9% of $100. It's 9% of $100. That's $9, and we have taken 70% of it. We have reduced it by the tax rate. So it's 6.3. 6.3 and 4.1 is the, okay. This is the present value of the interest payments that we will be receiving during the 5 years. Okay. Then we will also receive shares worth $122, but this will be a lump sum payment, a one-off payment. So we will be multiplying it with the discount factor and not the NVT factor. So can anybody tell me the discount factor for 5th year at 7%? Tell me the discount factor. Is it 0.713 or 0.621? 0.713, okay. 7% for 5th year. So what we have done is we have just taken the present values of the benefits. This will be the maximum value of the debenture. It's 113. Okay, thank you. So the market value of this bond will be $113. Dania, we are discussing how to calculate the market value of debts. Yesterday we discussed calculating the market values of equity, and today we are discussing how to calculate the market value of debts. So do we round it off to the whole figure? Yes, we can, and we usually do. Is conversion premium, is the conversion value? No, Talha, the conversion premium is different from the conversion value. We'll just be calculating it. Just hold on. So everybody got this market value? How we calculate the market value of a debt? It's very simple. There are no different models for calculating the market value of debts. The only thing that we need to calculate is the present value of all the benefits that we will receive from that debenture, bond, or any preference share. So all we have to do is to calculate the present value of the benefits, and the present value of the benefits will actually be the market value of the debt. So the market value of this bond is 113. Now let's see how we calculate the floor value. What is the floor value? Remember, floor value is, this is the maximum value that we have calculated. This is actually the market value of the bond. But the floor value is actually the minimum value of a bond. Remember, floor value will be either of the two. It will either be the market value of similar type straight debt. Straight debt means no conversion option. What do we mean by this? This bond has an additional feature of conversion. There might be a bond, say, of the similar company, Forbes company. So suppose that Forbes company has another bonds in issue which have no conversion option, and it's a straight debt, and it will be redeemed after 5 years at $100 per year, and it will give 9% interest for 5 years, and after 5 years it will be redeemed at par, no option. Now, whatever market value that bond will have, this convertible bond will have the floor value equal to that, because the the investors will have to buy this convertible bond for a minimum of that value. Because if they don't have, say for example, uh, the straight debenture that I'm talking about, the straight bond that I'm talking about, has a market value of $105. Now, if somebody is willing to buy a straight debt for $105, definitely this investor will be willing to buy a convertible bond with the same date to maturity, with the same interest rate, at a higher price than this, because of the conversion feature. Did you get it? The additional conversion feature will make the investor buy this bond for a higher value than this straight debt's value. This is called the minimum value of this convertible bond, the floor value. Any question? Rishabh Gupta, I have just assumed the market value of a straight debt. Maybe it might be trading in the market, and we have taken this price from the market. So at this point, I have just assumed that a straight debt has a market value of 105. Okay, let me repeat. Let me repeat. Let me repeat with figures. Suppose suppose Forbes company has same type of debt in issue, which has got 9% interest, which will give 9% interest every year and will be redeemed at par for $100. And this bond, suppose, is traded in the market for $105. Remember, I'm assuming that this bond has no conversion option. It's a straight debt and it is traded at 105. Now we have another debt of the same term to maturity with same interest rate, coupon rate, which has additional feature of conversion. What do you people think? This bond will be traded at a higher price than 105, at the same price as 105, or lower than $105? Yes, definitely at a higher price because of additional feature. If you get a mobile cell phone, which is additional feature, definitely you will buy it for a higher price because it has additional feature. So if you have got two cell phones in front of you, cell phone A, cell phone B, cell phone A and B has almost all the features, has almost same features, but cell phone B has one feature more than cell phone A, so you will be buying cell phone B for a higher price than cell phone A. That's the case here. A straight debt, since it has no conversion option, will always be having a lower value than the straight debt with a conversion option. Everything else will be same. So the value of this straight debt will be actually the floor value, the minimum value of this convertible debenture. That's what we say, because this is the minimum that a convertible bond will have. And somebody asked that was the purpose of calculating the floor value. The purpose of calculating the floor value is just to find out at what minimum value the company can still sell its convertible debenture, so that it is sure that it will uh, at least raise this much of capital if it goes for issuing the convertible debt. Usually the value will be higher than this, but this is just the minimum that the company will be expecting to raise by issuing a convertible debt. But what if we don't have similar type of straight debt in the market? What if we don't have this type of straight debt in the market? Then how will we calculate the floor value? So let's now see if there is no straight debt of the same maturity and the same interest rate in the market, then how we calculate the floor value. Remember, in case we don't have similar type of debt, straight debt, we calculate the floor value, that is the minimum value of a convertible debt, by assuming that it is a straight debt. Assume that this is a straight debt. Now, if it is a straight debt, what do you think? The investor will get 20 ordinary shares, which is equal to $122, or they will be redeeming this debenture for $100? Redeeming, definitely, because they don't have the option of conversion. Simran, they can't have $122 because there is no, we are assuming that the investor does not have any option of converting it. So they have to redeem. So we will solve the same question again. The way we calculated the market value, we'll calculate the floor value in the same way, but instead of taking the conversion value, we'll be taking the redemption value. So 6.3 will stay to be same because the interest payments will not be affected by the conversion or redemption, because for the 5 years time period, they will be getting interest whether they redeem after 5 years or they convert after 5 years. So 6.3 into 4.1, it will remain to be same. In calculating market value, we took the conversion value, but here we are assuming it's a straight debt, so we'll take $100 as the redemption value and multiply it with point. What was the discount factor? I just forgot. What was the discount factor? 0.713, okay. .713. So just add them. 95.13, okay. Now this is your floor value. So it's very simple. In order to calculate market value of a convertible debt, you have to take the higher of convertible conversion value or redemption value. But when it comes to calculating the floor value, we will always take the redemption value. In case the redemption value is higher than the conversion value, remember, if the conversion value redemption value is higher than the conversion value, the market value and the floor value both will be same. It's 97.13 or 95.13. Okay, 97.13, okay. Well, I totally depend on the figures that you people tell me. So if I make any mistake, you people are solely responsible for that mistake. Okay, I'm just going to repeat. Let us suppose that we have a convertible debt. The very first step will be to find out whether the investor will redeem it or convert it. Listen carefully. The first step will be to find out whether the investor will be converting it or redeeming it. And we all know that the conversion will only take place if the value of conversion is higher than the value of redemption. So if the conversion value is higher than the redemption value, it will be converted, and while calculating the market value, we'll take the conversion value as our 5th year figure. In case the redemption value is higher than the conversion value, then do you people think that it will be converted? No, it will not be converted. So in the first step, we know that the investor will not be converting it. Rather, he will be redeeming it. So we'll take redemption value as the 5th year value and we'll calculate the market value. So if we are going to calculate the floor value of the same, and we all know that in case of floor value, we always take redemption value. We always take redemption value. So again, we will be taking the redemption value. So the market value calculated will be the same as the floor value, because in floor value, we always take the redemption value, because this is the minimum that an investor will get. The redemption value is the minimum value that the investor will be getting. Yes, Muhammad Talha, in case we are asked to calculate the floor value, then we will always take the redemption value. We will ignore the conversion value. Ubaidullah, we will always take the higher of conversion value, excuse me, or redemption value and redemption value in case of market value. Nurul Hassan, 4.1 is the annuity factor for 5 years at 7%. Shiraz, yes, the second one is if you don't have a similar type of debt in the market, all we have to do is we have to assume the convertible debt is the straight debt, and we'll calculate its value assuming that the investor will redeem rather than convert. So we'll take redemption value as our 5th year value, and we'll calculate the present value of redemption value plus the present value of the interest payments. $122 come from 122 is the conversion value. When we were calculating the cost of debt of convertible debt, we learned how to calculate the conversion value, number of shares into share price into growth. So what is conversion premium? We're coming to the conversion premium. Just hold on. Let me first ask everybody, got what is floor value? Yes, Taha, you're absolutely right. Simran, floor value is either the market value of a similar type of straight debt, or uh, present value of the tax benefits, sorry, present value of the interest payments plus the redemption, present value of the redemption value. Okay, we should move forward. Conversion premium. Conversion premium is the current market value minus current conversion value. Current market value, we have already calculated it. It's 113. 113. And the current conversion value, remember, conversion value will always have the impact of growth because it's the value at the time of conversion. So we have to incorporate the growth. But for current conversion value, we'll just simply ignore the growth factor because we are going to calculate the value of conversion at point 0 today. So at point today, we'll just use the current market price. That's it. We'll not incorporate any growth. So there are 20 ordinary shares which will be converted, and the current market price is 4.45. So we'll just multiply 20 with 4.45 to get the current conversion value, and we will not incorporate the growth. So this is the current value of the conversion. 20 into 4.45. What's the answer? 89. Okay, thank you. $89. So current market value minus current conversion value, $24. This is your conversion premium. It's the difference between current market value of the debt and the current conversion value. What's the purpose of calculating conversion premium? Well, it's just it is giving you an idea that how much the share price has to grow to justify this current market value. Because if you are going to uh, issue this share, this debenture today, it will have a market value of 113. So every investor has to pay $113 today for against this debenture. And at the same time, they will know that the current conversion value of this debenture is 89. So they, by taking the difference, they will come to know that by how much this conversion value has to grow in 5 years to cover this $113 of investment. So it's actually telling you that how much addition in the conversion value should be there to justify this $113 investment. So today I'm paying $113, and after 5 years, what am I getting? If I convert today, I get 89. But if I convert it after 5 years, how much this 89 has to grow to get to 113 figure? So it's $24. The conversion premium has to grow up by $24 in 5 years to get to this $113 figure. I hope this has answered your question. Abrar, it has nothing to do with the valuation, but yes, it will help investor to decide whether to invest or not. It will be of some help, or it will give an idea of to the investor that how much growth the investor should expect in the share price, so that his investment is justified. So it's not that much important figure, but it can give some idea. Should we move forward? Well, this calculation might be done by the investor as well, not only by the company. If I'm an individual investor, I may not be involved in these calculations, but if I am an institutional investor, definitely even I, as an institutional investor, will have to make these calculations to justify the investment. Let's move forward. So we have this cash-based model. I will not go for the whole calculation of this model. It's least likely that you will be tested in the exam given this cash-based model. But even if it comes in the exam question, you'll still be able to solve it because we have already done it in the form of NPV. So I'll just explain it. I will just explain it. Can you people see the question on your screens? Yes, it's annoying. It's, I guess, the UPS sound. Let me try to fix it. Just give me a minute. Meanwhile, you people just read this question. I'll try to fix the sound. Just read this question. Okay, are you people done with that? Done with reading the question? Abrar, I will share my contact details, WhatsApp number with you. Just text me on that at the end of the webinar. I'll add you to the group. I will add you to the WhatsApp group. Okay. Now what we have to do is under the cash-based model, we have there is nothing different than the uh, investment appraisal question. It's totally the same. All we have to do is to calculate the present value of the cash inflows that we are expecting uh, from the takeover of the company. So, for example, if we take over a company and we expect certain cash flows every year, net cash flows, sales, less operating costs, uh, less working capital requirements, and all that stuff. So we will be calculating net cash flows for every year in the same way as we did it in the investment appraisal question. So we'll calculate net cash flows for every year. Then we will discount them with using our WACC of the investing company. Remember, when we were using dividend growth model, we were using cost of equity of the target company. But in a cash-based model, when we are calculating the present value of the cash inflows arising from the takeover of the company, we take the WACC of the investing company and not the targeting company. So this is the difference between cash-based model and a dividend growth model. So remember this thing, that using cash-based model, the investing company's weighted average cost of capital should be used in calculating present values. So all we have to do is to calculate the present value of the cash inflows arising from the takeover of the company. This present value will be actually the maximum value for that company. So this is the maximum value for that company. So no investor will be willing to pay more than the present value of the cash inflows of the company. So the investors will pay the maximum of the present value. So remember, the cash-based model gives maximum value of a company. But what you have to do is later, if the question asks to calculate value of equity, remember, the present value of the cash inflows from the takeover of the company is not the value of equity. It's the total value of the company. From the total value of the company, you have to subtract the value of debts. Once you are done with deducting the value of debts from the total value of the company, you will get the value of equity. So this is the difference. The dividend growth model or the price earning model or the earning yield model give you the value of equity. So you don't need to subtract any value of debts to get the value of equity. It directly gives you the total value of equity. But in case of cash-based model, it will never give you the value of equity directly. It will first give you the total value of the company, and from the total value of the company, you have to deduct the value of debts in order to get the value of equity. For example, if we solve this question of Duff Company and we get a total value of, say, for example, 800,000, the present value of all cash inflows. And then we calculate the value of debts, say, for example, the value of debts, debentures, and everything is 200,000. So we'll deduct 200,000 from 800,000 to get the value of equity. So the value of equity in this case then will be 600,000. I have assumed these values, so don't connect it with the question. Just assume it. So the things that you need to keep in your mind is you have to calculate the present value of all cash inflows the way we used to calculate in the investment appraisal question. We have to use WACC, the weighted average cost of capital, but the weighted average cost of capital should be of the investing company and not the target company. The third thing that we need to keep in our mind is that once we are done with calculating the present value of the cash inflows, it will give us the total value of the company. So do look at in the question whether they're asking for the value of equity or the total value of the company. So if they are asking for the value of equity, then you have to deduct the value of debts from the total value of the company to get the value of equity. Any question? Any question? Well, I can't see your questions on the screen. Any question? Okay, let me try to fix this problem. I'm not able to get your questions. Uh, can you people hear me now? Yes, Aisha, the 800,000 was the assumed value. I just tried to explain that suppose that we have calculated the present value of all cash inflows and we get the total value as 800,000. So remember, this 800,000 will be the total value of the company, not the total value of equity. So we have to subtract the value of debts to get the value of equity. Okay, Simran, the minimum value, remember, for a listed company will be the share price prevailing in the market. The minimum value for a listed company is always the value prevailing in the market, in the stock market. So that will be the minimum value. And in case it's unlisted company and does not have any market value in the stock market, then the minimum value will be the replacement value of its assets. That will be the minimum. So this the cash-based model is the same. Just look at the company as if you are buying a machinery, as if you are buying a machinery. So you remember when we were investing in buying a machinery, what we did, we tried calculating the present value of all the net cash flows arising from the purchase of machinery. And that was the maximum value that we were willing to invest. And then we will comparing it with the value of machine, the investment of the machinery, and we were accepting the purchase only when the present value of the inflows were higher than the initial investment required. So in the same case, if we are buying a company instead of buying a machinery, we have to calculate the net cash flows that we are expecting to get from the purchase of the company, and we'll calculate the present value of all those net cash flows. By calculating the present value of those cash flows, we will get the total value of the company. 800,000 is the present value. Manish, yes, the 800,000 is the present value of all the cash flows arising from the purchase of the company. Yes, Yesha, yes, you have to calculate the present value. What you people do is just solve it at your home, just calculate the present values, and today I will uh, put my video solution of this question on YouTube channel, and you can reconcile your solution with that. So all you have to do is to calculate the present value of all the cash inflows. That's it. Value of debt should also be calculated in the same way as we calculated the value of convertible debt in the previous example. So we have to calculate all the present values of the debts by calculating the present value of its benefits. Yashasvi, by the end of this 6-day session, all the recorded lectures will be emailed to you, all of you, or the link will be shared for the recorded sessions. Cost of, yes, the cost of capital will be 12%. Well, this will partly be solved using a perpetuity method, and partly in a normal way. For example, for the first 4 years, the cash flows are given, so they are different every year. So you have to calculate present value of the first 4 years cash flows separately, and for the cash flows of 5 years and there onwards, you have to calculate using perpetuity. Just do it at your home. Uh, and try doing it yourself, and I will upload the video solution of this question, and then you will know that how it was supposed to be solved. Sikandar, working capital. For working capital, I will upload the working capital videos on YouTube, so you people can go and watch working capital on YouTube as well. And then I will try to arrange a query session, and if not possible, you can always ask me on the group that we have created. Okay, let's move forward. Efficient market hypothesis. Efficient market hypothesis. Well, what is efficient market hypothesis? This is again a very important area for business valuation purpose. And what this is, let me explain. This is through an example. You are going to buy a car from your friend, and you know that the car is in a very good condition, it's well maintained, and you were ready to buy it for, say, for example, 10,000 US dollars. And when you were about to go to your friend to buy the car, uh, another friend came to you and told you about that the car has got a minor accident, and it has been damaged to some extent. My question to all of you: will you still be buying this car at the same value for $10,000? No. The value of this car is now going to be less than 10,000 US dollars, right? So the piece of information that you have got has affected the value of investment, right? Well, my question is that when you came to know that the car has got a minor accident, will you still buy this car for the same value as it was for before the accident? So yes, so it means that this piece of information, when it was made available to you, has affected the value of the asset, right? Okay. Now, how efficient you are in getting these type of information regarding the investments that you are making. The more efficient you will be, the more impact of information will be there in the valuation. If you didn't know about this information, if the car had a minor accident and you did not know about it, and you would have still bought this car for 10,000 US dollars, right? Yes, Rishab, definitely it will affect the value of the investment. So you would have still bought it for $10,000. So in the same way, let's look at it from a higher perspective. Look at the stock exchange. There will be so many people who will be buying shares of the company, of different companies. And the share price prevailing in the market depends on the perception of the investors. And the perception of the investors depend on the information that they get regarding the investments. So whenever a new piece of information comes in the market, it affects the value of shares. Agreed? In the same way as the piece of information affected the value of car. So whenever a piece of information comes in the market, it affects the share price. The share price will either go up or it will go down. So the share price will immediately reflect the impact of that information. How quickly this information comes in the stock market and affects the share price, this is called efficient market hypothesis. So efficient market hypothesis is a theory which states that the stock market incorporates and reflects in the share price all the relevant information available. So when you go to the stock market and look at the price of a particular stock, remember the stock indicates a certain information. So what types of efficiencies does a stock market show? There are 3 levels of efficiencies: weak form, semi-strong, and strong form. Well, theoretically speaking, the weak form does not exist. Remember this. It's a theoretical form of efficiency. Stock markets are usually semi-strong, and this form is illegal. We'll discuss it. So practically you will see semi-strong markets rather than weak or strong form. Now what does this mean? Weak form, where a stock market shows only historic information. What does that mean? Well, the share price, suppose that the share price of a company was $5 per share just before the profits were announced. The moment the profits were announced, the stock price, suppose it went up to $6 per share. It means it has reflected the impact of profit in the share price. Now, if the profits are earned, and everybody now knows it, and the share price only reflect the profits that are earned rather than that are expected to be earned. So if the share price in the market only reflects the profits that are earned, the mergers that have been done, the losses that have been made, and does not incorporate any information that has not happened yet, any information that has not happened yet, it means it has a weak form efficiency. And in such a market, the share price will always go up, the moment an information is made public regarding any future activity. So this is called a weak form market. Suppose company A and company B. Company A is going to acquire company B, but has not acquired it yet. But this company has made this intention public, but has not acquired the company B yet, but they have made it public. The weak form efficiency will never show the impact of this expected merger, since this merger has not taken place yet. Despite the fact that this information has been made public, the weak form will not show the impact of this merger, neither the positive one nor the negative one. The impact will not be shown in the price. The prices will not change unless this merger has taken place. So a weak form is such a form of stock market in which only historic information, the things that have already been done, will be reflected in the share price. Now, my question to you people is, if you are aware of the stock market dynamics, what do you think if company A decides to take over company B, which is a very attractive investment? If it decides to go for company B and all arrangements have been made, the information has been made public that company A is going to acquire company B, what do you expect? The share price will go up or not? Will the share price change or not if this information is made public? Will it change or not? Forget about going up or going down. We'll discuss it later. Definitely a favorable information will make the price go up, and the adverse information will make it go down. So let's not get into it. Just tell me, will the share price be affected or not? Yes, it will change. So it means that the weak form efficiency does not exist, because it states that the historical information will only be reflected in the share price. And since the merger has not taken place, according to this weak form efficiency, the stock market will not reflect this information, which is false. So weak form efficiency practically does not exist. Remember this. Now let's come to semi-strong. What does semi-strong efficiency mean? It means where share prices reflect both historic and publicly available information. In this case, since company A has not taken over company B yet, but has decided to go for it and has made this intention very clear, and it is highly expected that company A will take over company B, then the share price will be reflecting this information, because this information is now publicly available. Every investor in the market knows about it. So everybody will come up and try to buy this share, since they can see the company is going to increase its profits by taking over company B. So everybody will be willing to buy it for a higher price, and the share price will go up, because the demand of the shares will increase and the share price will go up. So the stock market will always show semi-strong form of efficiency. If you know anything that everybody else knows, will you be able to gain from this piece of information by purchasing shares? Will you be able to gain anything by purchasing shares because of this information? No, you won't know. You won't know. If you buy a share in this case, you will not get anything out of it because everybody else will have this information. So the price in the market will already be reflecting this publicly available information. So you are not new who knows this information. Everybody else knows it. So you won't get anything out of it. So in case of semi-strong form, no investor will gain, no investor will gain anything from knowing something that everybody else knows it. That is publicly available information. Let's come to strong form efficiency. What is strong form efficiency? Strong form efficiency reflects historic, publicly available information and non-public future information that is called insider dealing. For example, company is going to take over company B, but has not made this information public as it's a confidential information. They don't want people to know this. But in some way, this information is leaked in the market and everybody in the market knows it. So since everybody has come to know about this information that the company is going to take over, the share price will go up before the merger takes place or before this information is made public. So the share price has already gone up, say for example, from $5 to $6 because of this information. So the $1 change has already come because of this information. Now, the day when this information will be made public, what do you think? Will the share price go up further? No, there will be no change to the, theoretically speaking, there will be no change to this price because this price has already reflected this information. This has already come into the stock market before it was made public. So anyone who was anticipating this information will not gain anything out of it because the whole stock market is anticipating this information. So this is why it is illegal, because if a stock market always reflects such information, it means that it has a mechanism installed to take out the confidential information from companies. Because if it reflects, every time it reflects such information, it means there is a mechanism which takes out the confidential information from different companies, and no one can allow this. So insider dealing is illegal. So this is the illegal form of stock market, and no stock market in the world has this. So there are three types of market efficiencies: weak form, semi-strong, and strong form. So usually remember, semi-strong form efficiency will be there in all the stock markets. Weak form theoretically does not exist, semi-strong practically exists, and strong form, since it's illegal, so it does not exist. Semi-strong means the price will only change. Say for example, the price of a share is $5. It will only change when something happens that is becomes historic, or if it's not historic, it's publicly available. I mean, everybody knows it. It's publicly available information, even if it's not happened, but everybody knows in the market that it is going to happen. So if the stock market only reacts to two types of information, that is historic, something that has already happened, and something that has not happened, but the information regarding that event has been made public. It is publicly available information. It only reacts to these two types of information. Then it is called semi-strong information, and the price will only change once something has been once something has happened, or information about something that has not happened has been made public. Taha, yes, if everybody knows it, the price will go up for everyone. So everybody will be buying it for higher price because everybody knows nothing new. So everyone knows something that everyone else knows. So the price will be higher for everyone. And in case of semi-strong form, remember how an investor can gain. That's a question. How an investor can gain. I hope Taha, this is what you mean, right? The question, yes. How somebody can gain in a semi-strong form? It's very simple. I don't know the information. Nobody else knows any information. But I am anticipating that company A is going to take over company B. I'm the only one who's speculating that this is going to happen. Maybe say for example, maybe I have seen the director of company A meeting the director of company B. So only I know that, though I'm not sure what that meeting for, but I'm speculating that company A is going to take over company B. So I went in the market and just purchased the shares of company A because nobody else knows it. So the price will now be at a lower side. So I just purchased the share, speculating that the company A is going to take over company B. So by the day when it will be announced that the company A is now officially going to take over company B, the share price will go up. Since I purchased it for a lower price and the share price has gone up now, I can gain from that difference. Nobody else can because everybody else came to know when the information was made public. So the stock market in general has come to know when the information has been made public. But I, as an individual who was speculating it before, I get from this information. Uzair, strong form does not, in a strong form efficiency, nobody gains from any type of information, whether it's speculated or not, because speculation will be regarding something that is expected to happen. And since everybody will know that something is going to happen because the confidential information has been leaked, so nobody is going to gain from this information because the stock market is so efficient that everybody comes to know what anyone else knows. So in a strong form efficiency, it's very difficult for general investors to earn anything out of it. So it's only the semi-strong in which people can earn on the basis of speculations. Yes, there will always be risk, Taha. Speculation will always involve risk, and risk will always involve return. So in a semi-strong form, it's speculations that will help you earn. Immediately after the information is public. Well, who will define that this immediate? I mean, what do you mean by immediate? The moment information has been made public, if you can buy immediately, anyone else can buy it immediately. So what's the definition of immediate? It's a subjective matter. Manish, these days the purchasing and buying is done through applications. So the moment information is made public, everybody will have that application in their hand and everybody will be trying to buy. So the immediate definition is very difficult to say that immediately. Well, Taha, all the stock exchanges in the world exhibit semi-strong information, semi-strong form efficiency. And I told you that weak form will not exist, and strong form is illegal to exist. So the only form of efficiency will be the semi-strong efficiencies. So I hope now it's clear. Let's move forward. Theoretical X right price calculation. Now let's see how we calculate theoretical X right price. I hope everybody has got the concept of EMH. Okay, theoretical X right price. What's theoretical X right price? What's the right issue? First, let us explain briefly what's right issue. Right issue is when you give right to your existing shareholders to buy shares at a lower price than the market price. So this is the right issue. Uh, let's, look at this example. A company is considering a right issue of 1 for 4. 1 for 4 means that anybody holding 4 existing shares will get a right to subscribe 1 new share. At a 20% discount to current market price, the current market price is $2 per share. So they will get each share for 80% of the price. Calculate theoretical X right price and the value of right per share. Let's now calculate it. What's the right? Look at the basic example. Suppose that a company has only 4 shares in issue. Just listen carefully. The company has 4 shares in issue, and each share has a market value of $2. So 4 into 2, it's $8. So the total value of the company at the moment is 8. Suppose that it has the total assets in the company which is equal to $8. It has no liability, suppose that. So it has a total assets of $8. That's why its shares are being traded at a total of $8. Okay, now it's planning to issue 1 more share against 4 existing shares. So if it does it, it will have a total number of 5 shares. But the assets will increase by less than $2 because it will raise cash less than $2, that is for 80%. So what's the 80% of $2? It's $1.6. Okay, so the new share will bring $1.6 cash in the business, that is new assets of $1.6. So the existing value of the assets $8. The new assets will be $1.6. The total assets in the company will now be $9.6. Got it? So the total value of assets in the business will be $9.6, and it will be shared equally by 5 people or 5 shares. So what will be the value of 1 share after this issue? So 9.6 divided by 5. 1.92. So these total assets will now be shared by 5 shares equally. So each share will have a value of $1.92. And this is called theoretical X right price. So this is theoretical X right price. Now why we call it theoretical X right price? X right means after exercising the right, theoretically speaking, the price will be $1.92. Now why we say it's theoretical, the actual market price of the right issue might be different. Yes, the share price has gone down because the new share is just bringing $1.6, but the total value will be equally shared by the 5 shares, so definitely it will go down. So if you, it's just an example that if you take one paper, you score 90, in the other paper you score 90, in the other paper you score 90, in 4 papers you score 90, your average will be 90. But the moment you score less marks in the next paper, say for example in the 5th paper you score less than 90, and somebody asks your average, then do you really think it will still be 90? No, it will be less than 90. So this is actually the price per share. The average is the price per share, and the new share is bringing less than what the existing shares have. So that's why it will go down. So it will go down. So 1.92. So why are we calling it a theoretical X right price? Because the practical price in the market after right issue will be different, because it depends on the perception of the investors, rather than there will be so much rational calculation involved. So if we offer a right issue, the share price might go up. In this case, we expect it to go down. Theoretically, we expect it to go down, but it might go up in the market. Maybe the investors might start perceiving that the company is going to take over some profitable business. So in the anticipation, they will be ready to buy it for a higher price. So practically, it might go up as well. So that's why we call it a theoretical X right price, because in practice, the price might be different. Rishab, usually the right issue will reduce the price, because the right issue is usually at a discount. But if the right issue is at the same price as the market price, then the price will stay to be same, theoretically speaking. But usually, since the right issue is at discount, so the ex right price will always go down. Got it? Now let's calculate the value of right per share. What is this? If you are a shareholder, theoretical X right price is available to public. Rishabh, yes, it is available to public only if it is not taken up by the existing shareholders. First, it is usually first offered to the existing shareholders, and if the existing shareholders do not take up the right and they do not subscribe the shares, either they sell the right or they leave the right. In that case, it might be offered to the public even. So what is the value of right per share? The value of right per share. Well, if you are a shareholder, remember, if you are an existing shareholder and you know that the share price is 2, and immediately after the right issue, it will go down to 1.92. And if you don't have uh, enough money in hand to buy this additional share, and you leave it and you don't take up the right, you know that your share price will go down from $2 to 1.92. So you will be concerned about this loss. So what company does is it gives you the right to take up the shares, to subscribe the shares, or sell this right to someone else. So you might, as a shareholder, want to sell this right if you can't take it. Because if you leave it and you don't sell it or you don't take this right, you will lose 2 minus 1.92, that is 0.08, that is 8 cents per share straight away. So on every share you will lose 8 cents. Now, if you have the option of selling this right, for how much you will sell it to cover this loss? Definitely 8 cents. So what you have to do is just look at the current price and deduct from it the theoretical X right price. So 2 minus 1.92 is equal to 2.08. So you will sell this right for 8 cents per existing share to cover the loss that you are expecting to get after the right issue. This is called the value of right per share. So in the selling case, the shareholder's wealth will, well, theoretically speaking, he will not lose anything because uh, after the right issue, the price is going down by 1.9 to 1.92. So there will be loss of 8 cents, which the investor will cover by selling the right for 8 cents. So he will cover that difference by selling the right. If the proportion like 1 for 4 is not given, like equity value is given only. Well, Abrar, uh, uh, whenever there is a right issue, you will always be given the proportion. It's not possible that they won't give you proportion. It will always be possible to calculate the proportion. Simran, yes, I will explain the right value of right per share. We know that before the right issue, the price is $2. And we know that after the right issue, the price will go down to $1.92, which is a loss of 8 cents. So now if I am the existing shareholder, I would like to cover this loss. So one way of covering this loss is to sell the right. So I will sell the right of my existing share for 8 cents to cover this loss. This is called value of right per share. So we will try to sell this right for 8 cents so that the loss can be covered. So in trading case, what will he do? Taha, can you just explain your question? What you mean by this? So 1.92 is the price of share after issuing right. Yes, it's the right. It's the price after right issue. Who will buy it for the? Well, we can sell it to any other existing shareholder, or we can sell it to the public. In the public, it's our right. We it's these shares. We had a right to subscribe these shares, and we can sell this right to anyone else. It can be anyone. Well, usually, Sidra, there will always be a discount in case of right issue. So then I guess if it's not at discount, then there is no point of giving it in the question because it will not affect the share price. And if since it will not affect the share price, there is no point of calculating theoretical exercise price. So if the question asks you to calculate the theoretical exercise price, then it will definitely be involving any discount. Arslan, I can't. I will just share my number, WhatsApp number with you. Just text me on my WhatsApp then, and I will add you on the group. Okay, let's move forward. Business valuation section is over, and let us take a 10 minutes break, and after the break we'll start risk management. So I'll try to explain the whole risk management today and some part of the business finance as well. In case the time does not allow us to complete the business finance section, uh, I will also upload the videos of the business finance section on YouTube. And all you have to do is to watch those videos and note down your queries with you and ask me on the WhatsApp group. So whatever uh, queries you will have after watching the videos, we can discuss it on our WhatsApp group and on Skype or any other forum. Well, Abrar, tomorrow we will have a session of debrief. We will be discussing the mock. I guess the mocks have been shared with you. You have been emailed the mocks, so go and attempt the mocks today. And tomorrow we'll be discussing that mock exam. Okay, I'm just writing my WhatsApp number on the screen. 0092 321 2604033. If you are from outside Pakistan and from if you are in Pakistan, you just try 0321260433. So it's within Pakistan and it's for anyone outside Pakistan international. So just note down this number, text me on my WhatsApp with your name, and I'll add you people to the WhatsApp group. Okay, let us take a 10 minutes break. It's 11:25. We'll be back at 11:35. So go take a break because risk management is a bit technical. So I want all of you to take a break and then come back. Make sure that all of you are back at 11:35 so that you don't miss anything. Hello everyone, welcome back. Can you people hear me? Can you people hear me? Okay, okay, let's start risk management, and uh, I'll give all of you time to ask questions. So listen carefully. If any question comes in your mind, just put it down on a notebook. And when I give you time for asking questions, then ask questions. Uh, Risk management. What is risk management? Uh, well, remember one thing, that risk arises where there are variations. You always feel risk when you are not when you expect more than one outcome. Then you feel risk of not getting something that you would like to have. Was there? I will display it later. Kindly now we are starting the risk management, so we'll do it later. So risk arises wherever there are variations. I will just explain it with an example. If you are appearing in your F9 exam and you know that there is only one outcome, and that is you will score 90%, and nothing else is expected. You'll only get 90%. That's it. Not less than that, not more than that. This is the only outcome that you're expecting. Then there is no risk. If you like to have 90%, you'll go for the paper. If you don't like it, you'll leave it. That's it. There is no risk because you don't expect anything else. So risk is always there when you expect more than one outcome. For example, you might expect more marks, you might expect less marks. So the risk will be that you might get low marks. So risk arises with variations. So the types of risk that we will discuss will be exchange rate risk and interest rate risk. This is more technical, so we'll discuss it today. And for interest rate risk, I will just upload my video lecture. It's not that complicated, so it will be easy for you to understand. Once we are done with the exchange rate risk, it will be much easier for you to go through the videos of interest rate risk. Now, what is exchange rate risk? Remember one thing, this risk is only faced by a company who is involved in import or export, or both. So this is the risk faced by a company who is either importing from importing or exporting goods and are dealing with foreign currency. What is exchange rate risk? The risk that an investor will have to close out a long or short position in a foreign currency at a loss due to an adverse movement in exchange rates, also known as currency risk or exchange rate risk. Now, what does this mean? The investor will have to close out. Close out means when you settle a transaction, this means that you're closing out. A long or short position. Long position means when you close a transaction by selling currency. And if you are closing the transaction by buying a currency, it is called short position. So when you close a transaction to buy something, you are actually closing it out as a short position. When you are closing a transaction by selling a currency, it is called closing out as a long position. And a foreign currency at a loss. If because of closing out a long or short position at a loss, if you expect this, this is what your risk is. And let's explain it through this example. Let us assume that Mr. A sells a commodity for $1 to his US customer. Each dollar received today could be exchanged for, I've assumed the currency of Pakistan is Pakistan rupees. So it's a currency of Pakistan. So rupees 80. So let us assume that Mr. A sells a commodity for $1 to his US customer. Each dollar received today could be exchanged for rupees 80. So if I sell this commodity for $1 and I receive $1 today and I convert it into local currency, say for example 80. So against $1 I will receive 80 rupees. But if the customer pays in 1 month's time, what will happen? Let's say the risk to Mr. A will be that in the future he might receive less than 80 rupees of today. For example, after 1 month he might expect to receive 75 rupees against $1. So he has straight away lost 5 rupees just because of the exchange rate movement. This is not a loss that he has made due to selling the product. It is the loss that it has made due to exchange rate fluctuation. So he's going to lose straight away 5 rupees on each dollar. So this is the risk. That's called exchange rate risk. Now, if I am someone who is selling, say for example, who is exporting, say for example, chairs or tables, and I don't want to be exposed to exchange rate risk, because this is not what I'm expert at. I'm just expert at selling the chairs and tables. So I don't want to lose anything because of exchange rate movement. Then I have to go for managing this risk. I would try my level best to reduce this risk. I'm not viewable. You can't see me, Rishad? Okay. So I would like this risk to be reduced ideally to zero. I don't want to take this risk. I'm not expert of exchange rate transactions, so I don't want this risk. So I have to manage this risk, and ideally I would like this risk to be totally eliminated. If I do take any action to reduce this risk, it will be called hedging. It is called hedging. So I'm actually hedging the risk. So any action that I'll take to remove this risk or reduce this risk will be called hedging. Long position, short position, Mohammed Talha, if I close out any transaction by buying a share, it means I'm closing out as a long position. If I am closing out a transaction, if I close out a transaction by selling something, it's called I'm closing out as a long position. If I close out any transaction by buying something, it means I am closing out as short position. Okay, before we discuss methods of hedging, let us discuss the types of exchange rate risk. What type of exchange rate risks are there? One of the risk due to exchange rate movement will be the transaction risk, translation risk, and economic risk. What is meant by transaction risk? The previous example was actually a transaction risk. When you buy or sell something and you have to pay or receive in foreign currency, the risk that by the time when you will be paying or receiving the currency, you will make loss because of exchange rate fluctuation. That's called transaction risk. So you might have bought something for which you are supposed to pay after 1 month, or you might have sold something for which you are supposed to receive after 1 month in foreign currency. So in between this 1 month, if the currency rate changes in such a way that you make a loss, this is called transaction risk, because you have made a transaction and because of exchange rate movement, you are incurring a loss. That's called transaction risk. Translation risk. Well, if you are a parent company and you have a foreign subsidiary in any other country, you all know that you have to produce, as a parent company, you have to produce consolidated financial statements. Consolidated financial statements. So consolidated financial statements. Now, if the parent company's financial statements are in different currency, say pound sterlings, and the subsidiary, it's a US subsidiary, suppose it has its financial statements in dollars. So you can't add dollars and pound sterlings together. So you have to convert either of these two, and according to the standards, you have to convert the subsidiary currency into the parent company's currency. So all you have to do is to convert these dollar values into pound sterling values, and you need exchange rate for this. So let's suppose that you have bought this subsidiary for 1,000 US dollars, say. For example, you have bought this subsidiary, it's too cheap, but okay, it's good for us. So it's worth $1,000. You purchase it for $1,000, and after 1 year, suppose it still has a market value of $1,000, and during this 1 year, there has been no change to its value, $1,000. Okay, $1,000. You have paid $1,000 to purchase the subsidiary. Suppose against to buy these $1,000, you have paid, say for example, 500 pounds sterlings. So the value of investment in dollars at 0.0 is $1,000, and in pound sterling, the same investment has a value of $500. After 1 year, suppose that these $1,000, if converted in pound sterling, will have a value of just 400 pound sterlings. When I'm explaining the translation risk, just listen to what I'm saying. Aisha, just hold on. Just forget about hedging at the moment. Just concentrate on translation risk, what translation risk is. And so suppose that you bought this subsidiary for $1,000 by paying 500 local currency to get these $1,000. By the end of the year, suppose that these $1,000, if converted into local currency, will be just equal to 400 pound sterlings. So according to the standard, you have to add in your investments $400 instead of $500. So the opening value for the investment was $500, the closing value of 500 pound sterlings, and the closing value of an investment is 400 pound sterling. So don't you think you have made a loss of 100 pound sterling? Bilal, yes, the local currency, I've assumed the local currency is pound sterlings. So there's a loss of $100. So at 0.0, you will be concerned with this loss. This is the risk, that a pound translating the currency of foreign subsidiary into local currency, you might make a loss. And this loss is called translation risk. And this is a reporting loss. This is not a loss that is realized. This might get adjusted next day. The 500 might go up to the 400 pound sterling might go up to 500 the next day. So there will be no loss in actual. This is a reporting loss. This will affect your financial reporting. So this is called translation risk. Profit of 100 pounds in buying. Taha, we're not buying it. We have already bought it, and now we are showing something that we bought for 500 pounds sterling at 400 pounds sterling. So we have got a reporting loss of 100 pounds sterling. So this is called translation risk. I hope everybody has got this. So transaction risk arises when you have made some transaction in a short run and you have to receive something lower than you were expecting by the time when you sold it. In case of translation risk, it's a temporary loss. You can say it's just a reporting loss. It's not a loss that will be realized. It is just a loss that will be shown on the balance sheet. Well, Talha, the translation risk will always be there with where you have investment or borrowing in a foreign currency at the end of the year. It will be there because if you have a foreign loan, you definitely have to convert that foreign loan into local currency as well. So it will always be there when you have assets or liabilities on your balance sheet in the form of either having a subsidiary where you have to convert all the assets of the subsidiary and liabilities of the subsidiary into local currency. Even then you will face it. So wherever you have to translate your foreign investment or foreign liability into local currency, and by translating it you lose something, this is translation risk. Means you're not actually selling or buying something by making actual loss. You're just translating it for the sake of reporting it on the balance sheet. And just because of the translation, the value changes, and this change affects your profitability adversely, then this is called translation risk. Now let's go to economic risk. Economic risk is a long-term risk. Long-term risk. Transaction or translation risk. These are the short-term risks, and they arise due to temporary fluctuation in the exchange rates. If you look at the exchange rate of two currencies today, you might see it different tomorrow, and then next day it will again be different, and you'll see a fluctuation in the exchange rate on a daily basis. So this is the short term. You might see a foreign currency going up. You might see it going down. So it will be fluctuating from day to day. But there will always be an economic risk. What does this mean? Suppose that you have a foreign subsidiary. Same example. This is a temporary one. By the end of the year, the exchange rate has moved in such a way that you have to report something which you reported at 500 pounds sterling at the start of the year, and now you're reporting it at 400 pounds sterling by the end of the year, and the very next day it might get adjusted. But if the economy of one country, say country A and country B, the economy of one country, say country A, is continuously going down compared with the economy of company B. So it's continuously going down, it's continuously going up. So the exchange rate, now it will not be a fluctuation, the exchange rate will now be going down or up permanently. And after 3 years, say for example, when you sell this subsidiary, which you bought for 500 pounds sterling, you might be realizing just 300 pounds sterling, say for example. So you've lost 200 pounds sterling because of the deterioration in the economy of country A against company B. So economic risk is a long-term risk. It does not arise because of the fluctuation in the exchange rate. It arises in long run because of the poor performance of one country's economy compared with the economy of the other company. Mohammed Tala, which point are you talking about? There are no cash flow implications in the translation risk. No, there are no cash flow implication of translation risk, definitely. It's just a reporting loss. Remember, it's just a reporting loss. Is it because of inflation? The economy of one country going down will have multiple reasons, and inflation is one of the signs of economic hardship or prosperity. So, inflation is an indicator. Not because of inflation economies change, but because of economies the inflation rate changes. Dania, economic risk. Remember, economic risk is a long-term risk where one company's exchange rate is continuously, well, say for example, the value of one country's currency is continuously going down against the other country. So that's called economic risk. It's not a fluctuation. Let me give an example. Few years back, each dollar was worth 60 rupees, Pakistani rupees, and today it's around 106 rupees. This, you can't call this fluctuation. Each dollar is now around 106 6 rupees, and it was 10 years back. It was around 60 rupees. So this change is, you can't call this change as a fluctuation. This is due to economic conditions of the country, the relative economic conditions of two countries. Let's move forward. Now, why exchange rates will change? What's the reason for the movements in exchange rate? Number one, balance of payments, supply and demand of the currency. In a country, if you have, say for example, the foreign currency is, say for example, dollars, and you have a local currency of pound sterlings. So balance of supply of demand, the foreign currency supply in the country and its demand. If there is any change in the supply or demand of the foreign currency, there will be difference between the exchange rates. The exchange rates will change depending upon how much supply. For example, if the supply of the foreign currency increases in a country and its demand falls, the foreign currency will become cheaper compared with the local currency, and vice versa. So how will the supply and demand be affected? How a supply of foreign currency will increase or decrease, or how the demand of the foreign currency will increase or decrease? One of the reasons will be the balance of payments. Balance of payment, that is your import and exports. If your exports during the year increases compared with your imports, then it means the supply of the foreign currency will increase, or vice versa. Then there is political instability and economic performance, we've already discussed, and public debt financing. Your country might be paying off its debts in foreign currency. Say for example, if it's going to pay off its foreign currency debts, it will automatically stimulate the demand for the foreign currency. It will increase the demand for the foreign currency, and the value of the foreign currency against the local currency will go up. Vice versa, if you're taking a foreign loan, the supply of the foreign currency will increase, and it will reduce the value of the foreign currency. So these three areas will affect the supply and demand of the currency. Then we have difference between interest rates. So we'll discuss it in a while. Interest rate parity theory, and there will be the relative changes in purchasing power, and that is called purchasing power parity theory. What we call it the changes in inflation rates. Point 2 and point 3, political instability and economic performance. Do I really need to explain this? If economy of a country is going down, do you expect to have the same value, to have the same currency value against a foreign currency? Definitely, if the economic conditions are poor in a country, the value of its currency against a foreign currency will go down. Similarly, if a country is going to is expected to pay a foreign currency loan. Uh, it has to buy the foreign currency from the local market to pay its debts. So it will increase the demand of the foreign currency, and you all know that when demand of something increases, its price goes up. Usman, in every country there will be a supply of the foreign currency, that is the foreign currency coming into the country, and there will be a demand for the foreign currency, that is when it is paying for its imports, when it is paying for its debts. So it has to pay its debts in foreign currency. The demand of the foreign currency will increase. But and on the other hand, if the country wants to increase its supply, it has to increase its exports. So if the supply of a currency increases, it means you will have more of this currency against its demand, so the price will be reduced. It's a simple economic approach. If the supply of anything increases against its demand, its price will go down. For example, if there are 10 units to sell and only 4 units can be sold, then you have an excess demand of 6 units. This will reduce the value of that commodity because the supply is higher than the demand. On the other hand, if the demand goes up, it will increase the price of the commodity as well, whether it's any commodity or it's the currency. So all these 3 factors, these affect your supply and demand of the foreign currency. And once the supply and demand is changed, it will affect the exchange rate as well. Now, there are 2 other reasons behind the movement in the exchange rates. One is the change in the interest rates, and the other is the change in the inflation rates of the 2 countries. Let's discuss it one by one. Purchasing power parity theory. Purchasing power parity theory is based on the assumption that when inflation rates in 2 countries are different, during a particular period, the value of the currency will also change. Let me quickly explain it through an example. Suppose today $1 is worth £1. Assume that $1 is equal to £1. Okay, and you buy a commodity which is, say for example, you buy 1 unit of a commodity which is for $1 in US, and it is for $1 in £1 in UK. Suppose there's 10% inflation in US and 5% inflation in UK. So the same product which could be bought for $1 in USA today will be bought for $1.1 in 1 year's time. But in UK, since the inflation is 5%, the same product will be bought for how much? What will be the price of the same product in UK with 5% inflation? What will be the price? It's 1.05, right? Pound sterlings. So since this commodity, this product was traded for the same price, so both the currencies had the same values. But after 1 year, the same thing will have a cost of $1.1 in USA, and the same thing will be having a value of 1.05 in UK. So after 1 year, you can say $1.1 will be equal to 1.05 pounds sterlings. So if we need to find out what will be equal to 1 pound sterling, just divide 1.1 with 1.05 so that we will know that how much in dollars we will have equal to 1 pound. Oh, how much? It's 1.047. Okay, 1.047. Okay, it's 1.047. So you can say that after 1 year, $1.047 will be equal to 1 pound sterling. And if you see, it was $1 per pound here, but it is now 1.047 per dollar. So the dollars in relation to pound sterling has reduced. The dollar in relation to pound sterling has reduced in its value. You could have bought $1 by paying 1 pound sterling today, and in the future, if you pay 1 pound sterling, you will get more than $1. That is 1.047, and this is because of the inflation, the relative difference in the inflation. So look at this formula. It will give you the same answer. Let's solve it through this formula. S1 is the expected spot rate. In our example, it is $1 per pound. S0 is the current spot rate. It's the current spot rate. Sorry. Let's expected spot rate is the future one. Current spot rate is $1 per pound. Okay. HC is the expected inflation in country C. I will explain what is meant by country C. Expected inflation in country B. Remember, there will be two inflation rates in the formula. One is for country C and one is for, it's not company, it's country C and country B. Okay, let's put the values. S0 is $1. Okay. Then we'll have to multiply it with the inflation of country C. What is meant by the country C? Okay, tell me the exchange rate that we have put in the formula. Is it in dollars or is it in pound sterlings? How is it quoted? Is it quoted in dollars or is it quoted in pound sterlings? Quick. It is quoted in dollars. It is quoted in dollars because 1 pound is equal to $1, you say. So yes, it is in dollars. So you have to write the inflation rate of the country whose currency is dollars. That is USA. So you have to take the inflation rate of the country in whose currency the exchange rate is quoted. Remember, in numerator, you have to put the inflation rate of the country in whose currency the exchange rate is quoted. So we have to put 1 plus 0.1 because the rate has been quoted in dollars and the exchange rate in US, sorry, the inflation rate in US is 10%. So we have to put 10% in the numerator. And we'll divide it with the inflation rate of the other country, that is 0.05. So 1 into 1.1 is equal to 1.1 divided by 1.04, it will be 1.047. Still, it will be in dollars per pound. And this is your expected spot rate. You expect the future spot rate, the expected spot rate to be 1.047. This is what has been predicted by the purchasing power parity theory. I hope you've got it. So remember, if an exam question asks you to predict the expected spot rate, you will have to use purchasing power parity theory. Okay, let's move forward. In the same case, we have got interest rate parity theory. And listen to this carefully as well. It's a bit technical. Well, first change that you can see is its forward rate. It's not expected spot rate. It's not expected spot rate, it's a forward rate, and we'll explain the difference between the two, but it's a forward rate. Talha, forget about country C and country B. Just remember one thing in your mind. In numerator, we have to place the inflation rate of the country in whose currency the exchange rate is being quoted, has been quoted. In numerator, we have to place the inflation rate of the country in whose currency the exchange rate is quoted. And we'll place the inflation rates of the other country in denominator. So forget about C and B. Okay, Zan, be quick. Be quick. Okay, now just listen carefully and hold your questions till I ask you to ask. Look at this. We'll take the same example. US, say for example, in US, there is 10% inflation interest rate. The interest rate is 10%. In UK, the interest rate is 5%. And the current exchange rate is dollar per pound. Dollar per pound. Suppose I am it's UK. We are in UK. It's our home country. Suppose that it's our home country. It's our home country. Now, remember, I know the both type of information. I know what's the interest rate in US, and I know what's the interest rate in 5%. Don't you see there's a very good opportunity for us to invest in USA, because the interest rate in USA is higher. So we would like to invest in USA because we can get 10%. But what if we don't have this money with us to invest in USA? It's very simple. Just go and borrow from UK at 5% and invest in USA at 10%. So what an investor will do? He will go to the UK bank. He will go to a UK bank and say, for example, he's going to borrow 1,000 pound sterling from the UK bank. From the UK bank. And he will convert it into dollars. That is multiplied by 1 is equal to $1,000. And he will just invest in a US bank at 10%. After 1 year, he will get $1,000 plus 10%, that is $1,100. Suppose he will, after 1 year, it has to convert these $1,000 into pound sterlings. Now, since he's not sure what the exchange rate in 1 year's time will be, he will go at the time he took these 1,000 pounds, he will go to, suppose he will go to a bank and fix a rate, exchange rate, fix an exchange rate for 1 year's time. Suppose he got an agreement with the bank that the bank will exchange foreign currency for $1 per pound. Suppose that it's the case. So it entered in a contract with the bank that I will bring foreign currency, and you have to pay me at this rate. So the bank has fixed this rate with the investor. So after 1 year, if he gets $1,100, he has to convert it into local currency, and since the rate will be $1 per pound, so he'll get 1,100 pound sterlings, which he has agreed with the bank. So he got 1,100 pound sterlings, and he will have to pay off its debt. He borrowed 1,000 pound sterling, and after 1 year, it has to pay 5% interest on it. So it has to pay the principal and the 5%, which will be equal to how much it will be equal to? It's 1050, right? So it has to pay 1050 to the bank from which he borrowed these 1,000 pounds sterlings. So he earned $1,100 and he's supposed to pay 1050 1,100 pounds sterlings, and he's supposed to pay 1050 pounds sterlings. So what's the profit that he earned in local currency? It's 50 pounds sterling. So remember, it's so easy to do so, isn't it? Taking money from someone at 5% and investing his money in a market for 10% and earning $50. So do you really think it's that easy? Don't you think the bank with whom you were fixing this rate is not aware of this difference? So even the bank knows this difference. It's a publicly available information and bank knows this. So do you really think the bank will accept to fix this rate? It will never. So the bank will know that this is going to happen if it stays like this. People will borrow money from the bank, invest it at higher rate, and earn without taking any risk. You know, the process is called arbitrage, when you don't take any risk and you still earn something. So in practice, arbitrage does not exist. So the bank will never allow you to make such an easy money from their own capital. So what will happen then? What will happen then? Now, I'm just removing this whole from the slide to explain it further. Now, what will actually happen? This is the theoretical situation. No, Sidra, it's not a money market hedge. Just wait. I will tell you what money market hedge is. Just need to explain something. So I'm removing all this, and I'm now telling you what actually is going to happen. This is theoretical. This is ideal situation. But what actually will happen? Suppose you saw this, that there is a 10% interest rate in USA and 5% in UK. So you thought of borrowing from the UK bank and investing in the US bank. So, but before you do so, you went to the bank and tried to enter in a fixed rate agreement with the bank, so that you're sure that after 1 year there will be a fixed exchange rate at which you'll be converting foreign currency. So you went to the bank and asked to enter into a contract for a fixed rate, which is called forward rate contract. So forward contract, we call it forward contract. So you went to the bank and asked for this contract to fix an exchange rate. Now, how will bank fix this rate? Remember, the forward rate will be such that you can't make money out of this difference. And how it will be done? Just come here. Just look at this example. From this example, we need to calculate forward rate. What the bank will do to calculate the forward rate. So we'll just multiply the spot rate there. What was the spot rate in our example? It was $1. Okay, multiply by 1 plus IC, the interest rate in country C, and I've told you that whether it's inflation rate or interest rate, it will be of the country in whose currency the rate is being quoted. So what should I write here? 1.1. Okay, and I'll divide it with 1.05. So just give me the answer. What will be the answer? The rate that bank will fix with you will be $1.047 per pound. So I went to the bank and asked to have a forward contract. Bank said, okay, we'll have a forward contract, and the rate at which the currency will be exchanged in the future will be $1.047 per pound. Okay, I didn't make any calculation. I just fixed it. I just entered in the contract and the rate was fixed as 1.047. Now let's repeat that example which we had. After 1 year, this investor will have $1,100 from the investment. It will be converting these $1,100 into pound sterlings first. How many pound sterlings he will get at this rate? Because he has fixed this rate with the bank. So after 1 year, he will go to the bank will charge him $1.047 per pound. So against every 1.047, it will pay 1 pound. So how many pounds he will get? Okay, approximately 1050 pounds. Right? Approximately he's going to get 1050. Just need to divide 1100 by 1.047. So you just need to divide it. So approximately 1050 pounds sterlings. So Mr. A will have 1050 pounds sterling by the end of the year. He will go to his bank from which he borrowed 1000 pounds sterlings. So after 1 year, he will have to pay 1000 pounds sterling plus the 10% interest, which is equal to 5% interest, which is equal to 50 pounds sterling. So what he's supposed to pay after the end of 1 year, it will be a total of 1050 pounds sterlings. And how much he have? How much he has? He has 1050 from that investment, and the whole amount will be paid to the bank, and there'll be no profit out of it. So the bank will adjust the forward rate in such a way that you can't make this profit, because this is the piece of information that the bank will also have. So do you really think the bank will be so stupid to allow you make profit from the bank's money? It's the bank's money, and you can't make profit out of it without taking any risk. So this is what is the rationale behind interest rate parity theory. It says when there is a difference between the interest rates of the two countries, the forward rate will adjust in such a way that there will be no profit through arbitrage process. So you can use interest rate parity theory for calculating forward rate. So in an exam question, if you are asked to calculate forward rate, remember not to use inflation rates. To calculate forward rate, you have to use interest rates. But if you are asked to calculate the expected spot rate, that's the open market rate in the future. The difference between expected spot rate and forward rate is the expected spot rate is the exchange rate in future time in the open market. Whereas the forward rate means the rate that you will fix with the bank by entering in a forward contract. So to predict a forward rate, you need to use interest rate parity theory. And in order to predict the expected spot rate of the future, you have to use inflation rates. Yes, Aisha, the bank is supposed to win. So I hope you've got the difference between interest rate parity theory and the purchasing power parity theory. Should we go ahead? Thank you, Taha. Okay, let's move forward. Now there is international Fisher effect, and I'll just quickly go through it because we have already discussed two concepts, and it is the mix of the two concepts. International Fisher effect. What is it? Does that mean? The international Fisher effect is that if you take nominal interest rates of the two countries, if you take nominal interest rates of the two countries, remember there are two types of interest rates. One is nominal and the other is real rate. This is without inflation. This is with inflation. So what the Fisher effect says is that whenever you take nominal rates, whenever you take nominal interest rates in your calculation, it will always include the impact of inflation. So the difference between the real and nominal rate is actually the difference between inflation rates. For example, the basic rationale behind this concept is that the real interest rate in every country will be same. Theoretically speaking, the real interest rates in every country will be same. But the nominal interest rates in every country will be different. And if the interest rates are different in the countries, the exchange rate will be different. But since the real rate in the countries will be same, their exchange rate will also be same. But if the nominal rates are different, the exchange rates will be different. And the difference between real rates and nominal rates is because of inflation. So what do they say is that the relative difference between the interest rates of the two countries will be because of the difference between their relative inflation rates. So the international Fisher effect says that the interest rate, if they are different between two countries, remember, it is saying that if the interest rates are different between two countries, the reason is the inflation rate. Otherwise, if there is no inflation in the two economies, if there is no difference in the inflation of the two countries, there will be no difference in their interest rates. So, in a nutshell, it says if you use nominal interest rates to predict the exchange rates, it will have the impact of inflation rates. So it's not the difference of interest rate which is making the difference, it is the inflation rates which is making the difference. So this is what international Fisher effect is. It says that it's only the inflation rate that makes the difference. Did you people get this? Okay. Okay, Taha, let me explain again. International Fisher effect says that the interest rate parity theory and the purchasing power parity theory are the same. Because the change in the interest rates is because of the change in inflation rates. So whether you take the inflation rates to predict exchange rates, or you take the interest rates to predict the inflation rates, exchange rates, it will be the same, because interest rates fluctuate because of the inflation. So it will be the same. So you calculate using either nominal interest rates or the inflation rates, you'll end up with the same answer, because the interest rates. Yes, it means that they mean to say that there's no difference, because the interest rates, if they are different because of inflation. So let's move forward to hedging methods, how we hedge our risk. I guess Aisha, you wanted to ask something regarding hedging. Can you repeat your question? So we have two broad categories of hedging. One is the internal method and the other is the external method. The basic difference between the two is that for external methods, you have to go to somebody else. There will be a third-party transaction. And since the third party will be involved, there will be additional cost. So we have got two types of categories. The one called external hedging method, the other the internal hedging method. For internal hedging method, you don't need to go to a third party. Yes, for example, bank. Yes, right. Aisha, it will be our top priority to eliminate completely. But even if we are able to reduce it, it will be good. So hedging is not eliminating it at all. It is reducing it as much as possible. Okay, internal methods of hedging. Internal methods of hedging will be one of the methods will be invoicing in own currency. That is, for example, if I have sold goods to a foreign customer, and I have quoted price in local currency. Say, for example, my local currency is pound sterling. So I quoted the price in pound sterling, and I asked him to pay me in pound sterling. So if I do so, there will be no risk. The risk will be totally finished. So there will be no risk involved because I'm going to receive a local currency and I don't need to convert it in, at any time in the future. So I will not be exposed to any exchange rate risk. So this is one of the options that we can use to reduce, eliminate our risk. Exactly, Luke. You're right. Spot on. So you have to pay in pound sterling. Uh, so you'll always be facing this exchange rate risk if you're outside UK, right? So you can do it, but still companies don't do it. Even if the company wants to reduce its risk or eliminate its risk, it does not invoice in local currency. And why is that so? We'll explain in a while. Why a company does not uh, invoice the sales in its own currency. We'll just see. Then we have a matching and netting receipts and payments. We can have matching and netting. Netting means we can match receipts and payments. We can have uh, say, for example, if we are paying $1,000, uh, we can manage in some way of receiving $1,000. So if we have receipts and payments at the same time in the same currency, it will again eliminate the total risk because we're going to receive in the same currency and then we're going to pay in the same currency. We don't need to convert the currency, so we will not be exposed to any exchange rate risk. So sometimes it will match, or sometimes we have to do netting. For example, it's an ideal situation to have $1,000 of receipts and $1,000 of payments. So it might be sometimes like we might be receiving $1,200 and paying $1,000. So we'll just net it off, and then we'll only be exposed to an exchange rate risk on these $200 only. So it will not eliminate our risk, but it will reduce our risk. So we can do it at times by matching or netting the receipts with our payments. Then we can match assets and liabilities, by and large the same as the above. Leading and lagging. Well, what is meant by leading and lagging? Leading means paying early, lagging means delaying the payment. Well, if in case if you're expecting the payment, the exchange rate will change in such a way that it will make you make a loss in the future, you may pay early to avoid that risk, or you expect the exchange rate to be moving in a positive way in the future, and you're supposed to pay it now. You may delay the payment so that you can avoid the higher exchange rates of today. Yes, to some extent, Aisha, you're right. So leading means paying early, where you expect the exchange rate will go up in the near future, or lagging means delaying the payment if you expect the exchange rate will go down in the future. So it's leading and lagging. So in all of these four methods of matching, you don't need to go to any third party, and you don't need to spend anything extra. For all these external methods, you have to have some arrangement with a third party, and definitely it will involve some costs. in matching and netting can be supplied to foreign as well as you have to receive to pay US two companies and same in PK. You can ask the payment company to pay, still paying you. Yes, Vakas, it can also be the case where you can settle your foreign currency transactions in this way. Yes, it can be done. So let's uh, well, I think I've skipped. Okay, now why would a company still invoice in a foreign currency, despite the fact that it can eliminate its exchange rate risk by invoicing in own currency? Say, for example, if I'm a company and I don't want to take exchange rate risk, the best way for me will be to go and ask the customer to pay me in the local currency. So I'll totally eliminate my risk. But still I can't do this, or I don't want to do this. What could be the probable reason? One of the reasons of quoting the price in foreign currency will be to compete in the market. Say, for example, the customer has options of buying it from me or from my competitor, and my competitor is very much ready to quote in the foreign currency and take the foreign exchange rate risk. And if I don't, I might lose the customer. So in order to compete with my competitor, I might still want to quote the foreign to quote in the price in foreign currency. So one reason of quoting in the foreign currency will be to compete. The other reason might be that I want to pay any foreign currency debt. So I want my customers to pay me in the foreign currency so that I'm able to pay my debts in the foreign currency, in the same currency. So sometimes we might be paying off our debts or settling our liability in the same currency. That's why we would like our customers to pay us in the same foreign currency. So these are the probable reasons of why we will still be invoicing in the foreign currency. So we've discussed this. Let's discuss about forward contract quickly. We have already had some discussion about forward contract, and now let's discuss it in detail. What is a forward contract? A forward contract is called OTC transaction, over-the-counter transaction. How does it work? Say, for example, after 3 months, I have to make a foreign payment of $1,000. Okay, I'm afraid that the exchange rate might go up, and I have to pay more of pound sterlings in the future than I can pay right now. So after 3 months, I'm expecting the exchange rate to go up. So what I can do is I can go to the bank and fix an exchange rate, and we have seen how a bank calculates the forward rate. So we're not going to get into that discussion again. So bank will do its calculation, will come up with an exchange rate, we'll agree that exchange rate, and the amount of currency will be fixed. That is $1,000. The date will be fixed. Say, for example, the bank will ask that when am I going to buy these $1,000. So if I'm going to settle my transaction by buying $1,000 to my supplier, so bank will ask what's the date, at what date I'll be buying these $1,000 from the bank. So I'll have to fix the date. Say, for example, I say that it's 31st March. So the date will be fixed, the quantity of the currency will be fixed, and the rate will be fixed. So forward contract will be a contract between two parties in which the quantity of the currency will be fixed, the date will be fixed, and the rate will be fixed. And it cannot change, since it's a contract which is a binding contract, and it cannot change. No party will have the ability to change it at its own. So it will be a contract, binding contract on both parties. So it will be fulfilled. So this is what a forward contract is. And what are the limitations of the forward exchange contract? If you do this contract, what are the limitations? It's not possible to arrange foreign exchange contract for some currencies. That's one of the drawbacks. You can't have forward contracts for every currency, because the bank will not have trust or confidence on every currency. So it will have selected currencies for which it will be offering forward contracts. So maybe if the currency in which I am supposed to pay, the bank may not offer me that contract. So this is one of the limitations. So it deals in the major currencies of the world. OTC means over the counter, means it's not a standardized contract. It will be negotiated over the counter between two parties. The quantity will be customized. The date will not be a standard date. It will be a date decided by the parties. So that's called OTC. Okay, this is the first thing. There is a limit to time horizon for forward contracts. For the major currencies such as the US dollar, the euro, and the British pounds, forward contracts or with other major currencies can be arranged with settlement date up to 1 year forward. Usually, these are for 3 months or 6 months, and it can go up to 1 month maximum. So you can't hedge your exchange rate risk for a longer period of time using forward contracts. This is the second limitation. So if you are going to settle your transaction within 3 months or 6 months or maximum 1 year, you can have a forward contract. But for a longer period, the bank usually don't do forward contracts for longer periods. Now we have another method called futures. So it's not an OTC transaction. Futures are standardized contracts. It's just like you go for the clothes and you make them to order. So it only fits you. This forward contract is just like something make to order. And you might go for ready-made garments and you buy something which have standard sizes and anyone can buy it. So the difference between forward contract is the same. The future contracts. Forward contracts are customized contracts, right? As it is made on the request of customer. Yes, Aisha, you're right. If agreeing such contracts, there is no profit, no loss after hedging, then why do such contracts? Why don't we hedge in future? Amara, I'm not getting it. Actually, when we are trying to hedge a risk, we are not trying to make any profits. We can't, because if you eliminate risk, you won't get any return. So we're not going for any return. We are just trying to fix our cost so that we are sure what we will be paying in 1 month's time. That's the main objective of hedging exchange rate risk. So exchange rate risk hedging means that we want to be sure of what we are going to pay after some time in the future. So we don't want to make any profit, definitely. So how futures work? Futures, how do they work? Well, remember one thing. Since they are standardized contracts, they are traded in the market. Like shares are traded in the market, future contracts are already also traded in the market. People buy future contracts, people sell future contracts. And how does this work? I will just explain. Futures are not OTC. No, futures are not OTC. They are standardized contracts. You don't negotiate. Future contracts. They are standardized. If you like them, you go and buy them. If you don't like, you can't customize it. So that's why. So future contracts, they are standardized. They are traded. They have a market in which they are bought and sold. They will have future settlement dates, standardized settlement dates. For example, if you buy a September, say for example, you buy a September future. September future, what does this mean? It means if you buy it, say for example, on the 1st of October, you might sell it in between this time period. But by the end of September, 30th September, say for example, you have to close it. You have to close it. But you have always the option to settle it before that date. So it allows you flexibility. Unlike the future forward contracts. In forward contracts, you have to settle it on a specific date, not 1 day later or 1 day earlier. But in the future contract, there is an ultimate date. That's, say for example, it's the 30th September. But you can always settle this transaction before 30th September. So you'll always have flexibility. And it's a very good hedging technique if you are not sure about the exact date of your payment. Say, for example, I want to make a payment to my customer, but I'm not sure at what date I'll be making that payment. Or say, for example, I'm expected to receive a foreign currency and I'm not sure at what date it will be received. So I can have a future contract because it allows me flexibility to settle it within a particular range. So how does it work? Let me explain features a bit more. So though the calculation will never be asked, you only need to explain the features of the future contracts. But just to make understanding very clear, I'm just explaining it so that you're sure of how future works and how does it hedge your risk. Look at this example. Suppose we are going to make a payment of $1,000 in 1 month's time. We need to make a payment in 1 month's time, and today the exchange rate is $1 for £1. So this is what the exchange rate is, and I have to make this payment after 1 month. The risk is that the exchange rate might go up. So how can I hedge this risk? Maybe after 1 month I need more of pound sterling to get these $1,000, which I don't want. So what can I do is I may go to the futures market, and suppose that I found a contract of $1,000. $1,000. Remember, these contracts are standardized contracts and they have fixed quantity of foreign currency. I'm assuming that I have found exactly the same quantity contract which I was looking for. Sometimes I may not. Usually I may not. So let's say the standard size of a future contract is $1,000. So they sell future contracts in a batch of $1,000. Okay. Suppose it has the same rate as the open market exchange rate, though again the futures contracts, the exchange rate in the future contract will be different from the exchange rate in the open market, but I'm assuming that it will be the same. Say, for example, against $1 I have to pay £1. So I went to the future market and I bought this future contract. But now listen very carefully. If I go and buy $1,000 today in the future market, I have to make the complete payment for these $1,000. But if I buy a future contract, I don't need to make the complete payment. It's just like a down payment. When you purchase a property, you pay token money and you get 2 months time to make the full payment. So it's just like you're paying a token money for this contract. You don't buy this, you're not paying in full because you're not going to receive these $1,000 today. It's just a contract of $1,000 and you won't be receiving these dollars, so you won't be paying the full amount for it. So we'll pay the token money for this. Okay, leave it for now. $1,000 contract we have bought. So let's suppose after 1 month, this exchange rate goes down to $0.8 per pound. At 0.0, we could have bought $1 for £1, and now we have to pay £1 to get just $0.8. So if you go to the open market and start buying $1,000, what do you think? How much pound sterling I have to pay to get $1,000? Okay, just tell me, if I go to the open market and I buy these $1,000 after 1 month at the rate of 0.8 per dollar, how much pound sterling do I need to pay? 1250, yes, right. 1250 pound sterlings. And at 0.0, if I had to pay it at 0.0, how much I was supposed to pay? At 0.0. If I had to pay at point zero, it would have been 1,000 pounds sterling. So if you look at this, if I don't hedge my risk, I have to pay straight away 250 pounds more because of exchange rate movement. So I've lost $250. Suppose that I haven't hedged my risk. So straight away I have lost 250 pounds sterling. What I could have got for 1,000 pounds sterling, I'm going to get it for 1,250 pounds sterling. So I've lost. But remember, if I have entered in a future contract, I have bought a future contract at the same rate for $1. So for how much I have got this contract? I have bought this contract for 1,000 pounds. Though I haven't made the whole payment. Maybe I have just paid 100 pounds as a token money. So I have bought this future contract today by just paying 100 pounds or 50 pounds. Okay, after 1 month, what am I going to do is to sell this future contract. And I'm assuming that the future contract exchange rate moves in line with the open market exchange rate. So the exchange rate will, for the future contract, will also be $0.8 per pound. So I will have $1,000 of future, which I need to sell because I bought it and now I want to sell it. So I bought it for 1,000 pounds sterling and now I'm going to sell it after 1 month. So what do you think, how much I will realize by selling this future contract? 800? Are you sure? It's not 800 because I have to pay $0.8 to get 1 pound. Yes, it will be 1250 because look at this rate. After 1 month, I will have $1,000 of future contract. I will just sell it. Against every $0.8, I will receive 1 pound sterling. So I'll receive more than $1,000 because I have to pay $0.8 and receive 1 pound sterling. So I'll receive 1,250. So I'll sell this future contract for $1,250. You didn't get it, Aisha? Well, suppose I will have $1,000 and I'll sell it for this rate. So what I have to do is I have to give $0.8 to get 1 pound sterling. I have to pay $0.8 to get 1 pound sterling. Look at this exchange rate. What does this say? It means that $0.8 will be exchanged for 1 pound. So if I'm going to sell these $1,000, I have to give $0.8 to the customer, to the bank, and receive 1 pound sterling against it. So for every $0.8, I will receive 1 pound sterling. So more than that. So I'm going to receive 1250 by selling the future, and I bought this future for 1,000 pounds. So how much profit did I make from futures trading? $250. So by trading in the future market, I gained $250 pound sterlings, but by buying it in the open market, I lost $250. So I covered the loss of this $250 pound sterling by trading in the future market. If I had not gone for this future transaction, I would have lost just $250 pound sterling. But just by going into the future trading, I gained $250 pound sterling. I lost 250 here. I gained 250 here. So the loss was set off. Yes, the effect has been net off and we haven't lost anything. So remember, this calculation is not examinable. It was just to explain how future market can be used to hedge your risk. So you lost 250 in the open market. but you gain 250 from the future market, and this way you have set off your loss. So it will not be examined. So futures, uh, the problems with the futures, there'll be no perfect hedge. That in the previous example, it was a perfect hedge. You lost 250, you got 250. So it was a perfect hedge, but it was only possible because we got exactly the same amount of currency in the market which we needed. So we got exactly the same future contracts. Suppose that each future contract has only $400. So to cover $1,000, we will either have to buy 2 future contracts, but it will only have $800, or we can go for 3 future contracts and it will have $1,200 which are $200 more than what we require. So future contract most of the times will not give you a perfect hedge, because future contracts are standardized contracts and it will have specified quantity in each contract. You might be having more of the foreign currency by buying the contracts, or you might have less than what you require by buying the future contracts. So to some extent you will still be exposed to future exchange rate risk. So in this case it was a perfect hedge because we found out exactly the same quantity of the dollars which we needed. So just to make the example simpler, that's why I've assumed this. Secondly, the exchange rate in the open market has moved in the same way as it has moved in the future contract. So I've assumed these two things to make it simple, but remember, in practice these two things do not exist. The future market's exchange rate moves in different way than it moves in the open market. The exchange rate for dollars in the future market will be different than the exchange rate in the open market. So what are the advantages of the future market? One of the biggest advantages of the future market is that you don't need to know the exact date of your payment. It's not future options, it's just future options. Aisha? So for futures, well, the best thing about the future is that you don't need to know the exact date of your payment, because you have a time flexibility in it. For example, I just explained that if you buy a September future, you can close it anytime before September. So you don't need to have a fixed date for that. Yes, yeah, I will explain the color concept. It's actually the options. It comes in the options. So you don't need to be to know the exact date. Plus, since futures are tradable in the on the market, so you will always have buyers or sellers in the market. Disadvantages: the contracts cannot be tailored to the user's exact requirement. I already explained. Hedging inefficiencies: I have already explained that the risk may not be fully hedged. You still will be exposed to some risk. And again, futures do not exist for every currencies. They exist for major currencies in the world, say for example dollar, pound sterlings, yens. So you can't have future contracts for every currency. And we have got currency options. It's an alternative. It's an alternative to forward contracts. In forward contracts, we need to know the fixed date of the transaction, and we cannot skip the contract. We have to fulfill the contract in any case. It's a binding contract. But what is good about the currency option is that though the date will be fixed here, the amount of currency will be fixed here, but it's always at the option of the holder whether he or she wants to exercise it or not. For example, if I have bought options from the bank to buy $1,000 at a rate, say for example I have to buy it on 31st Jan. So the date will be fixed, okay, the amount of currency will be fixed, but it's always at my discretion whether I buy it on 31st January or not. Maybe I just leave it and I don't buy them. So it's always at my discretion that whether I go for it or I don't go for it. So for example, if I were to buy a dollar, $1. If I were to buy $1, uh, and I have fixed a rate with the bank, say for example against £1, so I have to pay £1 to get $1. So suppose that after 1 month, the rate is just $0.8 per pound. So if I pay £1 and I get 0.8, I will never go to the bank and never, because I will lose. So I will lose. So if the moment I feel that I will lose by buying the currency from the bank, I will just leave it. I won't go for it because I have the option of leaving this contract. This is what I can't do it in case of uh, forward contracts. In forward contract, I have to go for it. So I will just leave it because I have the option of not doing it. So I have the option, unlike the forward contract, to skip this contract. Can you people hear me now? Okay, so I have the option to leave it if I feel that going for this will put me in loss, so I'll leave it. So I will always go for it when it's favorable for me. So I will not go for this option. So for example, let's say I have arranged with the bank that I have to buy $1,000. And these $1,000, against these $1,000, I have to pay 1,000 pounds sterling. Okay, this has been fixed with the bank. In 1 month's time, suppose in the open market, I can buy these $1,000 for just paying 800 pounds. And if I go to the bank, I have to pay 1,000 pounds because I have this option with me. So what do you think? Should I go for it or not? Should I go and buy from the bank, or should I go and buy it from the open market? Yes, open market. And I will go to the open market and pay 800 pounds to get $1,000, and I will leave this contract here because it gives me the option to do so. I can't do this in the forward contract. I have to go for it, even if it's giving me a loss. So this is what the beauty of the options is. But the date will be fixed, the quantity will be fixed. The only thing is that whether I want to exercise it or not. So this is what options is. Now, what will be the benefit for bank in this case? It's always beneficial for the holder because he will always look at his own benefit. So what is the benefit for the bank? The benefit for the bank is at the time of buying this option, the bank will charge premium. Because you are transferring your risk to the bank, and the big bank will ask for a fixed premium at the time of purchasing the option and not at the time of exercising the option. At the time of exercising the option, you have to make the payment for buying the currency. But for buying the option, you have to pay a premium at the time of buying the option. So bank will ask for the premium later on, whether you exercise or you don't exercise it. It's up to you. So you have to pay the premium. So we have got two types of two types of options. A call option. Well, a call option means the bank is giving you an option to buy a currency at some future time. The put option is the option that the bank is giving you an option to sell the currency at some future date. So it's just the term used for buying or selling the options. So features of the options, currency options gives you the holder right. It gives you the right and not the obligation to exercise the option. So if you want to do it, go for it. If you don't want to do it, leave it. And where the currency options are more useful, the currency options are more useful when you are when you're not sure of whether you will receive a payment or not. It's not about the date of receiving it. If you're not sure about the date, it's a future contract that will help you. But if you're not sure about the receipt of payment, whether you will receive it or not, then it's better to go for currency options. So currency options can be purchased over the counter. Means it's this like forward contract. It might be customized or it may be traded. If you want to go for standardized options, having standardized dates, standardized currency, so you can go for it. Or if you want to negotiate it, if you want to negotiate with the bank, you can go for it as well. So we have already explained the advantages. I think today it's Friday, so we should continue this tomorrow. And tomorrow we'll be having our class at 2 p.m. I guess Pakistan Standard Time. I think you would have got the email as well, so just check the email. Don't look at this. This is just information. Just reconfirm it. You might have got a reminder for tomorrow's class. So it will be at 2 p.m. Pakistan Standard Time. You can see your emails. You may have got the reminder as well. So we'll continue this tomorrow. It will take a half hour tomorrow, and then we'll have a mock debrief tomorrow as well. Well, Yesha, I will explain this color transaction tomorrow because before I explain the color option, I'll have to explain the floor, and I'll have to explain the ceiling, and then I'll have to explain the color because I have to explain these three concepts. Well, for all the other topics that we were not able to cover, I will upload the video lectures, and I've shared my WhatsApp number with all of you. You can ask questions regarding those video lectures. If you have any problems in the video lectures regarding explanation, or you have questions, you can ask me on the WhatsApp group as well. So I'll upload the video lectures. Today I will upload the video lecture for capital structure, and I will also upload the video lecture for sources of finance. Muhammad Abrar, kindly note down my number 032126040033. Text me on WhatsApp. I'll add you on the group. And if you're adding it from outside Pakistan, don't forget to add the country code 00923212604033. So anyone outside Pakistan. Well, Taha, we have covered investment appraisal except the asset replacement decisions. We have covered everything else in the investment appraisal. We have covered the complete cost of capital. We have covered the complete business valuation, and we have covered the risk management so far, but we'll complete it tomorrow. So the risk management will also be fully covered. So what we are left with is the sources of finance and the working capital section. So I will upload videos for those, and it will be of great help to you. And not only this, I will have a detailed video on the futures trading as well. Because of time constraint, I only focused on what you will be asked in the exam, so I just focused on that. I will have a detailed video on futures trading as well, how futures are traded on the futures market, and how futures help you in hedging the risk. So. Usman, my video about working capital will have everything in it. How you will be examined in the exam, and the concept, everything will be in the working capital management section. So just keep in touch so that you know that the video has been uploaded, and I'll make sure that I upload uh, the video for business finance today, and tomorrow by tomorrow I will be able to upload the video for working capital management as well. Sundas, don't worry. Once you watch that video for working capital management, I'm sure you'll have no problem in attempting the exam question. Well, Taha, you can say we have covered up to 65 to 70% of the syllabus during this session, and the rest of the 30 to 35%, it will be covered through video lectures. So rest assured that the whole of F9 will be covered. Okay, it's prayers time. So we'll be meeting tomorrow. Yes, by tomorrow I will try my level best to upload the working capital. It's quite a big area, so if not tomorrow, then definitely day after tomorrow it will be uploaded on the. And I hope today's lecture was helpful. I tried to cover many things in a little time, so I hope it was good for you people. Yeah, I know, Shiraz, because of the time constraint that we have, it's a quick revision session, so I will try to be uh, discussing in detail in my video lectures because I don't want to be having any time constraints in that. So that will be of great help to you all of you. Yes, in the business finance section, I will also cover Islamic banking as well. Thank you, Manish. Well, thank you to ACCA for giving this opportunity to you all as well. So meet you tomorrow. Uh, just kindly check the email for tomorrow's timing so that you don't miss it. I hope you've got the email for today's slides along with the mock exam as well. Thank you very much. Okay, bye bye. Have a good day.